Hi, welcome back to Whiteboard Wednesday. Today we're going to cover something really important to buy-to-let landlords, which is thinking of the mortgage to choose when you're looking to buy buy-to-let property. There's two ways to do it. You can get a repayment mortgage where you're paying it back every single month, or you can get interest only where you're only paying the interest on the mortgage. So we'll look at those alongside the lending criteria that banks are looking for, the advantages and disadvantages of each, and then the model is really what you're looking for. Both models we're looking at really are for risk-averse landlords who are looking to build growth in the long term, possibly as a pension replacement plan. So we'll start on that just now. Lending criteria, first of all, we've touched on it in parts before, but we'll do a bit more detail on that. For example, we've spoken about loan to value before, where the bank's really looking for you to have 25% deposit and they'll provide the other 75%. So that's a 75% loan to value. Other things the bank's really looking at is the rent to interest figure. So for example, if a mortgage is coming in at £1,000 per month, the bank will really be looking for that to generate £1,300 of rent. So you've got a good cover well above the mortgage itself, and you're comfortable every single month. Lastly, they might look at yourself in terms of your own salary, and a lot of banks are really looking for a minimum of £25,000 of your own personal earnings before they would enter into conversations about offering a buy-to-let loan. So on to the two vehicles themselves. On a repayment mortgage, like we said at the start, you're repaying that mortgage every single month, so it's constantly going down. This is the cycle here. So you start off here in year 0, going down to year 15, 20, 25, depending on your choice. Capital is very, very simply paying it off the whole time. With interest only, what you're doing is just paying the interest on that. So you're going to have to find some way of paying down the actual capital that the bank is giving you at the start as well. So advantages of the repayment mortgages: it is a safer vehicle, there's not a lot to think about, it just gets repaid every single month, and it brings the debt down every single month for you. Disadvantages being it can bring obviously a lower yield because the mortgage is that much higher, so your yield struggles a bit, the yield being what you actually take on rent versus the mortgage. And then it can be hard to hit this figure we're talking about here, your rent to interest figure. It can be harder to hit that if you've got the higher mortgage, so worth thinking about when you're getting into that. Pros and cons of the interest only vehicle is advantages being it gives you a much better yield, so you can use that money at your choosing. Obviously what we're recommending with this model is you use that spare money to pay the mortgage down, much like it was a repayment mortgage. It's also more flexible, so like I say, you can take that money, be it spending on property repairs, getting into another property, it's your choice, but you've got to balance out with how you're going to repay that mortgage in the fullness of time. And that's really where the disadvantages come in. It requires a lot of discipline to have an interest only mortgage, because you do have to be thinking, how am I going to pay that capital sum down? And if you take a payment holiday, that could be costly. So if you decide, well, we'll not pay off more of the mortgage this month, we'll take a wee break from that, that means it's going to take you longer to pay off the capital itself. So that's a real kind of whistle-wind tour of interest only versus repayment mortgage. If you're looking at our sourcing services, this is part of the consultation we work with our landlords on. So if this is something you're thinking about, do give us a call and we'll be happy to help you out. Thanks for now.